Saturday, July 27th, 2019, Monaco 64, home of alternative economics and contrarian views. Today I want to warn my British viewers, my UK viewers, it's where I'm based, and I feel obliged to warn them about the oncoming inflationary onslaught, and to warn those people who have sterling savings or Bank of England savings in the bank that the value of their savings is going to be wiped out. It's already being wiped out over the years, but it's going to get even worse, in my opinion. And why do I say that? Well, because the policy of the Bank of England, of the British government, has been one of inflation for the last 100 years. And I'll look back at history, the 100 years before that and the last 100 years. It's just amazing the difference in policy that we had during the Victorian era up until the just before World War I broke out in 1914, and the policy that we've had since then. It's just like night and day. The only consolation is that I don't think it can get any worse, and that we're near the end of this period of complete debasement of the currency and inflation, rising prices. And before I go on, I'd like to tell all my viewers everywhere else around the world that this applies to any other country, the United States included. And I'm focusing on the UK because this is where I live, and I want to warn the viewers. But it's the same for everyone. We're not under a gold standard anywhere in the world. We've got inflation, which is the creation of money and credit out of thin air, which is debt. We don't have a gold anchor. So just wanted to say that before. So I've been warning my viewers since I started this channel back in the end of 2015 that we're going to continue to see a devaluation, a debasement of the British pound or sterling, whatever you want to call it, sterling, pound, British pound, Great British pound. Continue to see that. And why? Well, because we're in so much debt, just like all the other countries. I've got usdebtclock.org, but it's got all the different countries. You can see the US is at the top, $22.5 trillion. And it's running quite quickly. It's more than 100% of GDP. It says here public debt to GDP. I guess that's only the debt that's held by the public, but overall the national debt is over 100% of GDP. Then you've got China at 9.5 trillion. Their public debt is 61.7. Their external debt is only 12%. And then you've got Japan. But then you've got the UK here, $3.5 trillion. We're almost up to 100% of GDP. Our external debt is 187.7%. And the problem with that is that the UK currency, the British pound or sterling or Bank of England note, is not the major reserve currency that it used to be up until the outbreak of World War I. It's still a major currency, but there's not as much demand for it. So the Bank of England has kept a policy of very low interest rates for the last 11 years. And many people think that interest rates are normal now, but they're not. So yeah, many people think that having a base rate at under 1%, I think right now is 0.75%, is a normal thing. But I've got this chart here, Bank of England base rate history. And this is from smalacornmoney.com. And you can see there, it's basically from 1694. I think that's when the Bank of England was founded. And by the way, today, July 27th, is the birthday of the Bank of England's 325th birthday. So interesting that I'm making this video today. You can see there that up until the early 1800s, the base rate was pretty much fixed at around 5%. And in the 19th century, it fluctuated between 2 and as high as 8%. You can see there in the sometime in the 1850s, but it was pretty much between 2 and 6%. So it probably averaged between 4 and 5%. You can see that in the 30s and all throughout the 30s and in post-war Britain, just after World War II, that the base rate was fixed at 2%. But I would say that the fact that the pound started devaluing and that there was so much debt that they couldn't hold rates that low for that much lower. So that's why we got interest rate rising there up until the 80s, all the way up to 17%. And it's been going down ever since. But what I think the Bank of England is doing now is inflating the system. What they did, like in the 30s, mid 30s to late 40s, financial repression, investors were punished for holding Bank of England notes. There was inflation, and the interest rates didn't cover the inflation at the time. So as you can see, we're even below where we were just before World War II and after World War II. It's unprecedented. Now, before I go further, I'd like to look at a story. I saw a headline today in the shop. I took a photo of this headline in the Daily Mail, and they're warning the public. The Daily Mail, by the way, is probably the most widely read tabloid in the UK, very popular. So a lot of people are going to be reading this. They're warning, plunge of your holiday pound. Blow for families as sterling hits lowest rate ever against euro for July getaway. The pound is worth just €1.11 and $1.24 on the money markets. Sterling has not been a lower against the euro in any midsummer since its launch. The decline has fueled fears over a no-deal exit from the EU. So I said this back in 2016 many times, that they're going to keep using Brexit as a scapegoat for the inflation that we're getting. And by inflation, it is the inflation of the currency. That's what it is. We're printing, the system is creating or printing too much credit, too many Bank of England notes, because the Bank of England is keeping interest rates at almost free for banks. Banks continue to create credit, continue to basically increase the money supply. So it's a simple law of supply and demand. The more you create of something relative to other things, that thing will lose value relative to other things that are not created as much. And that's what's been happening to the pound. And it's not because of Brexit. Brexit maybe helped the pound go lower, but it was going to happen even without Brexit. They're just warning them that they need to maybe buy euros now before it goes, the pound drops further to go on their holidays. They don't warn them that we've had 100 years of inflation and that their savings in the bank is going to be wiped out in terms of purchasing power. Of course, if you have £100 or 10,000 pounds at the bank, it's going to be there in 5 years' time, but it's going to be buying a lot less. And they don't warn people about that. I just want to show you a very long-term chart of the pound versus the dollar. So it's how many dollars you get for a pound. And this is from 1870 to roughly present day. It might not be exact. And it just goes to show that this is nothing to do with Brexit. This is nothing to do with short-term movements. This has been the policy since the breakout of World War I. It has been a century of basically inflation, of devaluation of the currency. So you can see there under the classical gold standard that lasted until 1914. The 19th century and just before the outbreak of World War I, £1 was fixed at $4.87. That was the classical gold standard. So there was no inflation in the 19th century all the way up to 1914. And I'll prove that to you in a minute. I'll show you some Bank of England data. But you can see there that World War One broke out. They devalued the pound against the dollar. Then Winston Churchill was the chancellor, and he went back on the gold standard at the same rate that they were at before World War One, which was a mistake because they created so many paper claims. So it was a mistake to go back at the same rate. So they had to leave the gold standard in 1931, and ever since then, we have been on a fiat regime where there's no anchor, and that's why the pound has been going down and it's accelerating. And it's going to go towards zero, not just against the dollar, but against gold, of course. What's the purpose of having the anchor of gold? Well, the anchor of gold limits the amount of credit that the system can create. And why is that? Well, because the credit has to be backed by gold. And if you create too much credit that is unbacked, there's a danger of bank runs. And that's why it keeps the system honest. And you have to really earn your money. You have to earn your money before you create the credit. It's just a shorter term chart. I think now we're moving another leg lower. And why is that? Well, because we had the financial crisis of 2008. And in order for the government to save the banks, or the City of London for that matter, they had to indebt the country to the tune of over £2 trillion. In just before the crisis of 2008, the national debt was around £600 billion. Now it's over about 2.2 trillion, probably maybe even more now. So that's why the more debt you create, the more money you create, the less it becomes valued relative to other things. That's what inflating the currency means. And that's reflected in a higher cost of living. And I get comments from a lot of my viewers in the UK about how everything is going up in price. Well, if you think about it, it's the pound that's going down. When you buy a loaf of bread or you buy a drink, those drinks, that bread doesn't change. It's the money that's losing value. So we can see the policy there of this century has been one of devaluation, and it's going to continue, and that's going to mean inflation. And you can't protect yourself from inflation right now in the bank because you're getting 0%, and inflation is running at around 3%. The RPI at least, maybe even more. The CPI is running at 2 or 2.5. Savers are getting punished. They can't save. People who try to get a return on their savings, they're putting money in riskier assets like bonds, like funds. And we know what's happening. Woodford Fund, many people have had their money frozen with that. And yeah, anything that is offering rates of 5% or more is very risky. But at the same time, you're getting zero from the bank. And so you can understand why people are doing that. I'm going to reference this book now, War and Gold by Kwasi Kwarteng. He's an MP, conservative MP, and he wrote this book. It's War and Gold, a 500-year history of empires, adventures, and debt. And just going to show you how different the Victorian era or the century up to World War One was or has been from this century, the last century we've been in since the end of World War One, 1918 to now, 2019, in terms of inflation, debasement of the currency, and the debt. The debt is important, and I'm not a prophet. I'm not trying to guess what's going to happen. It's just common sense that it will happen because there's no other way out for the government to carry the debt or the country to carry the debt. You have to make it worth less, and you do that by issuing more and more of that debt and credit and that money, and you take it off gold as well. There's no backing to it as well, right? And we've been under a fiat regime in the UK since 1931. So let's go back here to London 1914. That's the chapter here. And this is very interesting. This is just goes to show you how the amount of debt we have now is not normal. This casual Edwardian idiom about the government shouldering the whole thing went to the core of the issue. The British government, in its fiscal policies, had been impressively consistent for 100 years. Remarkably, the century from 1815 to 1914 had seen British nominal national debt actually fall. The debt in 1818 stood at 843 million. After a century of balanced budgets, the figure stood at just under 706 million in 1914. This fact was a great testament to prudence and financial restraint, a legacy of the attitude towards public finance of such statesmen as Sir Robert Peel and his protege William Gladstone. By 1921, after 4 years of carnage and 3 more of financial upheaval, the gold standard was still suspended and the national debt had soared to 7.8 billion, a nominal increase of 1,154% in just 7 years. So the national debt from 1818 to 1914 went from 843 million to 706 million. But then by 1921, it was at 7.8 billion. And now, 100 years later or so, we're over 2 trillion pounds. So you can see that it's been night and day. And the main reason for that is that there's no anchor to the monetary system. And debt has become money. The debt balloons. It balloons in the aftermath of World War I, and it has ballooned since then. Yes, the country went back on the gold standard for 5 years, from 26 to 31. But basically, we have been off the gold standard since 1914, and that's why the debt has gone up so much. And I'll show you how that affects inflation or prices. Prices, of course, rising prices are a consequence of inflation. Inflation is not the rising prices. Inflation is the creation of money and credit, fiat money and credit, right? So I have to thank the Bank of England for this because they have an inflation calculator. And what happened in the late 1700s, early 1800s, well, we had the Napoleonic Wars, and actually there was the Bank Restriction Act of 1797. Parliament suspended the Bank of England, didn't have to convert banknotes into gold. That was for about 25 years, just under 25 years. So we'll look at what inflation was from 1797 to 1821. That's when you had the gold standard or convertibility suspended by Parliament. You can see there that you needed £1.14 to buy 1 pound of goods, 1797 goods equivalent. So you actually had inflation averaged, or the rising prices averaged 0.6% a year, which in today's terms is very low, but that was actually unusual for that time. So now let's go and look at inflation from 1814 to 1914. I know the Bank of England started redeeming gold again in 1821, but let's do it for the whole that century. So you can see that 1 pound in 1814, you only needed 69 pence by 1914. So the pound actually, the purchasing power of the pound actually went up. You needed less than a pound to buy 1 pound of goods from 100 years. So you can see there, inflation averaged minus 0.4%. And that was during the classical gold standard, just before World War I broke out. So now I want to look at what's happened in the last 100 years, where we've had no gold standard, basically. We've had debasement of the currency. And why has the currency been debased? Because the currency has been inflated into existence in massive terms. And that's why you've had rising prices and rising debts. You can see 1 pound worth of goods in 1914. Now you need 113 pounds 35. So inflation averaged 4.7% a year. So it's even worse than when they had the suspension during the Napoleonic Wars. That was 0.6%. Now we've had almost 5% inflation annually for the last 104 years or so, ever since the end of World War I. So when you see articles like that in the Daily Mail, yeah, they're not doing their homework. They're not really warning you about the longer term picture. Let's have a look in the last 18 years since the beginning of the century. We're told that central banks, being independent now, have been doing a great job, that there's no inflation. Bank of England only has data to 2018. So a pound in 2000, nowadays you need £1.65. So inflation is averaged 2.8% a year. And that's CPI inflation. But I've got some data from Hargreaves Lansdown, a financial firm in the UK, a brokerage house, and they've used the RPI. So the RPI is a better reflection of prices, how prices are rising. You can see here a pound in 2000. Nowadays you need 2 pounds, and it's averaged almost 3%. And that's the RPI there, as you can see. Bank of England now uses the CPI, so it's even worse. So can you see why the pound is continuing to go lower when interest rates are almost at zero, and you've got inflation, or the measure of inflation, or prices running at 3%? So how do we protect ourselves, the general public, against this onslaught of inflation that we're going to get? I really think we're coming to, how can I say, a big acceleration lower of debasement of the currency. That means the pound will drop a lot. That means everything is going to be more and more expensive. It's very difficult to protect yourself. It's much easier, of course, for the very wealthy, for the people in the City of London, for politicians. They get access to the money first. They are well advised. They don't keep too many sterling. They don't keep too much money in the bank. They put it in hard assets. Yes, they are well advised. They convert it into tangible goods, precious metals, land, wine, other currencies, even though I don't recommend other fiat currencies. But you as a average person, or even if you're not an average person, if you do have a lot of money, I personally think, and what I've done that has protected what my pound purchased back in 2002, and it still does now, is that I've converted some of my savings into precious metals, gold or silver. And I get a lot of comments about people here in the UK saying that they can't get themselves to buy silver here because of the VAT or VAT. But I just want to show you a receipt of when I bought, I think it was one of the first times I bought silver. And it was from Gold Investments, the people I have the promo code with on my channel. So yeah, If you are thinking of buying precious metals, you can use Monaco64 promo code at Gold Investments. You get a 0.5% discount when you buy gold or silver through them. They're arguably one of the oldest bullion dealers in the city of London. They're family run. So here's the receipt. I still keep it. Gold Investments. And I bought 1 silver kilo bar. I paid 118 pounds, as you can see here. The VAT was £20.65, I think at the time. It was less than, the VAT was less than 20%. So 138.65 for a kilo, that's 32.15 ounces. That's £4.30 I paid for that. When I have to say I was a little bit worried about paying the VAT at the time. But if you look at where silver is now, £13.26. So does it really matter, the VAT? Let's have a look here at the price of gold. And I've got the LBMA website. The price of gold in pounds, XAU GBP. I think we closed yesterday around 1,146. We're very near the all-time high, which was hit at 1,195. I think it's just a matter of time until we break out through that level. And I'll just show you another chart going back all the way to 1968 when the data started being taken by the LBMA. You can see that you needed, I think it was about 17 pounds for 1 ounce. I know a lot of people are struggling. They're having even to borrow money at the end of the month to pay the bills. But for those of you who are fortunate enough to have savings in the bank, this is not a recommendation. This is just what I think. I think those savings in 5-10 years time are going to buy a lot less in terms of purchasing power. Yeah, it might go from 10,000 pounds now to maybe 10,300 in 5 years time, but it's going to be buying a lot less goods. I remember when I first bought one of these, a gold sovereign, it cost 50 pounds. Now it costs almost 280 pounds. So if I hadn't put some of my savings into precious metals, I wouldn't have protected the purchasing power. That's what it does, precious metals, protects this purchasing power. So is anything good gonna come out of this? Maybe. Looking back to 1914, just before the outbreak of World War I, things were great in the UK. And then all of a sudden things flipped. And since then it's been downhill for the pound. So, and I think we're very near the bottom, but I think the last drop is going to be really, really bad compared to the gradual kind of drop we've had for the last 100 years. Maybe things will be a lot better going forward in the next 100 years. Looking back to 1914, if you told someone in London just before World War I that in 100 years time we'd have over 2 trillion in national debt, that our currency would have been almost wiped out against the dollar, that the UK wouldn't be the world power that it was, people would probably laugh at you. So maybe, yes, things are bad now. That doesn't mean that they're going to be bad going forward. And if you are able to protect some of your savings, maybe you'll be able to come out on the other side and maybe prosper from it. I'm just giving you my opinion, what I think the money's going to do. The Bank of England note, their sterling, is going to continue to lose value. And if you hold on to that, even if you have accumulated big amounts of sterling reserves, it's going to become worth a lot less, in my opinion. And why is that? Well, because the debt is insurmountable and it's going to have to be written off. And usually it's written off through inflating it away. If you enjoyed this video, make sure you hit the like button. Make sure you share it far and wide as well. Also, if you're not a subscriber, think about subscribing. And you can also follow me on Twitter, Steemit, and on DTube. I wish you all a great weekend. Take care. Bye.